What's going on, guys? Welcome back for another episode here on Let It Grow Investing. I'm Jeff. We're going to be getting caught up on the market here. We've got a lot to get covered. It's been a while. It's been a couple of weeks. Man, it's just life just gets in the way, right? So we're trying to get caught back up. I was a little bit under the weather a couple weeks ago, and then we had a full weekend, 3-day soccer tournament for actually both of my kids did, and yeah, we took first place with my team that I coach, and the younger team they did well. Finished in on Sunday with a strong finish. Saturday didn't go as well for them, but anyhow, we're getting back into it, right? So I'm trying to get caught up on all things market, all things stocks and investing, Bitcoin. What's going on with the market, what's going on with unemployment, fuel prices, everything else. So it's a lot to get caught back up on. So my apologies on not being here, but yeah. So I guess first up. Yeah, the market, man. The market has been brutal. I'm down probably six figures at this point from peak to trough, probably back from maybe October, November kind of time frame. And this year has just been not going our way. I was saying that, hey, we could see some sort of breakout in Bitcoin after we got down into the 80s. It hasn't happened yet. Why? Well, there's a lot of different fears out there. We've got rates staying higher. Bitcoin does better in a low interest rate environment, and we're looking at the CME, the Fed Watch tool. I'm going to pull that up, and that is not looking like a big friend of us right now either. So if I go over here to the Fed Watch tool, what is the Fed going to do? What are we looking at? Well, we are currently sitting at a target rate of 350 to 375, and let's back up one second. 350 to 375. This is for the April 29th meeting. Doesn't really look like we're going anywhere. Maybe 4% of economists saying we go up to 375 to 400 basis points. And, by the end of the year, say December 9th, right? We're still looking at 72% of economists saying we're going to be at 350 to 375. And then 22% saying we're going to go up a quarter point. Yeah, inflation, right? We're trying to tamper that. We can't really get away from it. We've been calling for lower rates for a while. It's not happening. We've got a period of maybe stagflation, right? Where the economy is stagnant, but prices keep going up. We saw a little bit of that on the jobs report as well. I'm going to go ahead and switch over, and this is just Google Gemini. So this is the February numbers. U.S. economy unexpectedly shed 92,000 non-farm payroll jobs. We also have unemployment going up to 4.4, reflecting a slower labor market. We've also got, with those job losses, hourly wages growing about 3.8% annually, which is, more than inflation. But if people are losing their jobs, 92,000 in a month, that is something to be a little bit concerned about. So a lot of different pressures here on the market, right? We've got rising costs, rising fuel, war in Iran, problems around the world, geopolitical tensions, uncertainty as to who's getting paid with TSA problems right now. I'm hearing BWI, Baltimore Airport, has probably some of the longest lines at TSA right now, and they're about 5 hours. And I know quite a few people flying out today as I speak. A couple families made it through in about 3 hours, and that was getting there before 3 a.m. just to make it through TSA. Other people that had later flights, they have reported up to like 5 hours of being lines outside of the gates, lines through the terminal, just way out of the normal operating procedure. So problems there, right? Those people aren't getting paid. I think Trump is trying to get those people paid, trying to force that through and get people back to work so we can get back to a regular kind of spring break travel season. So a lot of different fears out there. I think most of which probably stems back to problems with Iran. We're really watching that. We're watching what happens with the government. We're seeing this stagflation. Diesel prices by me are in the mid fives. I've seen people posting that they're up to like $8 in California, and around the world even higher than that. So everything is just putting a pinch on what we can spend and then what stocks you want to buy in a market like this, right? You really don't want to be in those consumer discretionary type funds or individual names like Nike that we were looking at the beginning of the year at $63, has been getting just beat down. And where are they now? Where is Nike? And is it one you'd want to buy? It's at 51. $51 on Nike. You're getting an over 3% dividend yield. So is it something that's going to turn around right now? No, I don't think it's going to. But if you got a long-term time horizon on something like Nike, I think it's probably something that you can go ahead and purchase if you know that you're planning for 12 months out, for 24 months out. Is it going to just bounce back when fuel prices come down? Probably not, right? I think it's got a little bit longer of a rebound window after consumers feel a little bit more comfortable. And, that's ultimately who's buying Nike products, right? It's not a B2B type company. It's going to be more B2C, business to consumer, rather than business to business, versus something like an AMD that I think you can buy handily now at 200. I feel very comfortable with this one. So I will be adding to this. I'll probably be adding to some Nike, knowing that we've got a longer turnaround, but I am comfortable with purchasing both of them, really. And I see a lot of fear out there. If I'm looking at the VIX, has it spiked up? We can take a look here. We are seeing the VIX getting back up to 30. That is going to show us that there is more fear in this market over the past month, right? So we were down here March 23rd, and this chart looks a little skewed because this should be a 1 month chart, and we're 5 days back, and it's showing me that much. But now we're up to 3105. That is getting into that extreme fear index. Blood in the streets is often the good time to buy stocks. So there's a lot of people saying, hey, should I get out of gold? Should I get out of silver? They're tanking. I think you're too late, guys. I'm going to be real honest with you. If you wanted to get out of silver, it was when it hit like 110, not when it goes down to 63. I mean, that's economics 101. You want to buy low and sell high, and people are looking to buy high and sell low. So, do your own math there. That's just your fear, and that VIX showing you that people are nervous about what's going on in this market. But if you wanted to sell silver, you should have done it back here when it was at 105 or 109 back at the end of January. That was the time to sell it when everyone was trying to crowd into this trade. That's the time to sell it. So, in my opinion, unless you bought at 20 and now you're sitting on a 3X from a couple years ago, why would you sell it if you were buying it at 75, right? I would say average down. I've told you guys this time and time again. If I buy Nike at 62 or 63 and it goes down to 51, wouldn't that be a better time to add it if I had high conviction into that name to begin with? Well, yeah, but the psychology of the stock market, the psychology of what we think we want to avoid fear at all costs is really difficult to do some of these practices that we've talked about for years now. Do I want to see you guys lose money on these? No, but I think now would be the better time to buy it when the S&P has gone down into correction territory, right? We are down over 10% on the year to date on the S&P. So if we're looking at this, we hit 641 on January 28th. And we're, more than $64 down from that at this point. So, we're really close. Maybe not exactly. What's the numbers? 18, 41, or 59. Yeah, we're call it 10%, right? I know we hit below 10%, and we can officially say that we hit into a correction territory. We might have bounced back up a little bit on Friday at some point. I could take a look at the 5-day and see just where we got to. It was at a low today. Yeah, we're right there. We're right 582. We're close, right? So anyhow, we're in that territory of correction. That doesn't mean we need to run for the hills. This is when you want to be able to dollar cost average. This is when you want to have cash on the sidelines to go ahead and invest. And I've had this happen time and time again, where I've been out of money at the beginning of the year from paying everyone for all my snow services and paying other contractors, paying laborers, and I haven't gotten paid yet. So I couldn't really buy the dip. Well, this year, I'm starting to get some money rolling in as the market's going into correction. So I'm pretty excited about this because of the fact that I get to buy shares at a discount. If you are excited about buying AMD at 249 and you can buy it now at 200 and you're saving 20%, that's a good thing. At least in my mind, that's a good thing. That's where I want to buy this thing. If I was looking to buy Nvidia, which I did add to the investing challenge purchase earlier this week, you know, that $200, it bought me a share and a quarter rather than simply, zero point 0.9 shares. And so I'm happy to be able to accumulate more shares before the market goes on a tear. At some point, it will happen. So for me, that's what I'm looking at. We're looking at Nvidia with about 63% of upside here. That makes sense to me. And again, this might be a long-term turnaround, but I'm okay with that. I'm okay with buying Nike with 43% of upside. SoFi has been just getting clobbered. A lot of rate problems there, a lot of fear, a lot of consumer uncertainty, job market uncertainty. At the beginning of the year, we were looking at SoFi at 27.46, if I can read my writing. And now we're sitting at $15.23. So you can almost buy double the amount of shares than what you could have been able to purchase at the beginning of the year for the same exact money. So you can take that for what it is. If you have high conviction in these names, there is no reason to run for the hills, and you just got to be ready for a little bit of pain. But we're already in the pain. So would you rather sell and take the loss, or would you rather buy in and know that this is going to get smoothed out at some point in time? I don't think it's the mortgage crash of 07, 08. I don't think it's the dot-com bubble of 99 or 2000. I don't think it's the 87 crash. I don't see that, right? I see some pain in the market. I see inflation. I see problems with Iran, but this is nothing different than some other problems we've had in geopolitical tensions before. This is not the end-all, be-all crisis that some people are making out to be, in my humble opinion. So do with that what you may. Do your own homework. Do your own due diligence. But I don't see the problem of running for the hills when you can get some of your favorite stocks much, much cheaper. That's across the board, guys. We're looking at CRM. CRM, if I go ahead and pull this thing up, where were we at the peak? Oh, let's see. We were at 296. This is last May. So that might be a little bit skewed, but where were we year to date, right? We were 260, right? We were 260. Now we're at 180. That's a better time to buy, in my opinion, if you have long-term conviction in a name. Right? So CRM, am I, stomping the table or smashing the table saying we have to buy every last dollar of every one of these? No, but I feel like it's a better time to maybe double your investment, right? We've talked about that before. If your favorite stock goes down by more than 20%, increase your weekly or your monthly contributions to it by double until it gets to a point where it's within 10% of its highs again. Right. So say, for this example, CRM, say it was at 260 and we wanted to be buying more under 20%, $26 times 2, that's 52. So we're buying more when it goes below 208. Does that make sense? We're taking 20% off the top. And if it goes below that 208 threshold, that would be 20% peak to trough. We want to double our investment. So instead of maybe buying $200 a week, we would want to buy $400 a week until, say, CRM gets above 208. At that point, we just continue our regular dollar cost averaging of $200, right? So in my theory, we're buying more now rather than buying less because we're getting a better value. We're getting a better value, and we should be investing more. We should be sitting on our hands and maybe not buying as much Starbucks coffee, but buying more Starbucks stock, right? That is what I'm trying to say. We don't want to just go and blow all of our money on things that we don't really need when we have other things that probably should be taking more of a priority in your investing journey, right? So a lot of different things out here that really make sense to me. And it's going to be really, really hard to buy just one name this week because you got Amazon with 42% of upside, Nvidia with 60% of upside. We had Nike with 40% of upside. Now, do all of these things just equal that, it's just going to come back right away? Are some of these numbers old? Yeah, they are. But I really feel strongly that buying these stocks, these high quality, high conviction names that you wanted at 20% higher from here, why are you not now buying them when they're 25, 30% lower and you're getting a better entry on these individual names? It just makes no sense to me. Is Google a worse company than what they were 2 months ago? No, they aren't, but they've come down, right? I was looking at this thing at 305 trying to get back into it when I sold off from that covered call at 325. So I sold 100 shares at 325, and now I get the option to buy them back at $50 cheaper. Yeah, well, that's a no-brainer. I still really like Google. I like that they're getting into more AI and everything that they're pushing into, new different coding that they're getting into for AI. I was seeing something about that. So I still like the company. They're still doing great things. YouTube hasn't slowed down. Their core business hasn't really slowed down. We were worried about a lot of ChatGPT kind of taking some of their market share on search. That hasn't really happened. Gemini's been rolling out strong. So why do we not want to buy it at 275 when we were looking to buy it at 315? That doesn't make any sense to me. So if you're on the fence about these, I think you got to hold your breath and dive into some of your high conviction names. And that is what I want to do. So as money comes rolling in, I'm going to roll it back into some of my high conviction names. And I mean, for right now, for this week, right, it's the ones that I've been looking at for the whole year, right? And it's the names that I already have a high position in that I want to get more shares of. So for this year, we're looking at Nike, SoFi, Salesforce, Adobe, AMD, NVIDIA, Microsoft, Amazon, Celsius, GE Vernova, Netflix, and Bitcoin, right? I was looking at Bitcoin at 93,750 on January 2nd when I made this note. And now it's at $66,000 or $67,000. Yeah, now, well, I feel like I'm getting a lot better of a value. It's gone down because rates are going up. It's gone down because there's a lot of tensions out there. And now I'm not saying that you need to be, heavily into crypto, but I think some exposure makes sense. Do I think that Nike or some of these other consumer discretionary stocks are going to bounce right back? No, I already said that. But I do believe long term, it is a safe bet. And I think you're getting it at a discount compared to where it should be trading, right? You're getting a 3% yield on Nike, which is almost unheard of. You're getting a quality company that had a lot of different troubles with management, with China, with other problems, right? And now you're getting a company that is posting a 3% dividend yield at a yearly low. And last August, it was at 80 with the analysts saying it's going to get to 70. So you're still getting a quality company, and you're getting it with a lot of the headwinds already been kind of taken out of the sales, right? A lot of these problems have already been addressed. Now we're just fighting some shipping problems, some consumer discretionary problems. Do they have the funding? But how long does that last, and how long until we can start to see some bluer skies and some greener grass when it comes to Nike? I think we're trending in that direction, right? They figured out a DTC a lot. They figured out that they do need to be in some stores. They don't want to just simply push all direct to consumer and leave those other outlets, other sales positions out of the scenario, right? So they're figuring that out. They're coming out with a different mix of products. They're doing a lot of different things. Now, am I saying you have to go and buy Nike? No, I'm saying look at stocks that have been through some trouble. They're still caught in the crosshairs of what's going on in the world, and we can figure out what to do from here. So, any of these stocks I feel strongly about that we could go ahead and purchase, right? I definitely feel like, the AMDs, the NVIDIAs, Microsoft being down significantly this year is one that I feel strongly about that shouldn't be at 356. So is it a stock that you want to buy? Well, I mean, for me, it is. It's got 63% of upside. It's a great company that is going through some problems right now. The PE's at a 22. That's slightly higher than what the S&P 500 trades, although I think NVIDIA was at a 21.1 and the S&P was sitting at a 21.4. That was on forward though. So Microsoft's forward PE is probably even cheaper. They got great earnings. The dividend's nothing to write home about, but it is a great company at a discount. So again, why are we throwing them out just because there's some geopolitical tensions out there? I don't think anyone's stopping doing their work on Microsoft Word. They still got everything going on the AI side and everything else that they've got going. So I'm not looking at this thing as being a long-term laggard. I do think that these are going to start coming back around. So if we go and we look up Refinitiv, we're going to share this tab. Looking at a buy, I'm going to move my little pop-up screen out of the way. We've got buy rating from 59 analysts, right? We've got 61% of upside. Earnings are looking strong, right? 13.64 and 25, up to 16.59 and 26, and $19 per share in 2027. So a nice little climb there, right? Annual revenue up 16% in 26 and 34% by the end of 2027. Revenues are trending right. Earnings are trending right. Dividends are up double digits, 10.1% dividend growth over the past 12 months. We're looking at a dividend payout ratio of only at 22%. So they can raise that dividend comfortably and still have enough money to look into building out more capital expenditures, whatever they want to spend that money on to grow the business. Makes sense to me, right? We've got forward PE of a 20.8, and the S&P 500 right now is trending at a 20.5. So the numbers I was quoting you are a little bit dated, probably earlier in the week before everything dropped, but it is at a 32% discount to where they historically trade of a 30.5. So you're getting it at a discount, right in line with the S&P 500. But I think overall, you've got a mixture of companies in there that the banks or the consumer staples, they're going to trade much lower. Your tech companies tend to trade much higher on the PE metrics because of the growth that they can give you on revenue and earnings versus, say, a utility company that might be thrown into the mix with the S&P 500 as well. So a lot of different things I like here, right? Forward PEG ratio is a 1.3. We like them being under a 2. The 5-year average is a 2.1, and the S&P 500 right now is sitting at a 1.6. So it's trading cheaper on growth compared to the S&P 500 as well. So a lot of different things I like here. So again, where do we want to put this money, right? I mean, it's really hard for me to just pick one because I want to buy so many things right now. Microsoft makes a lot of sense. You got a lot of upside. It's been traded down. I do think that your NVIDIAs and your AMDs might rebound quicker, simply because they're closely tied to AI and a lot of things can be very fast moving. So there might be a little bit more volatile. Microsoft is kind of caught in some of those crosshairs that they might not get out of for the next couple months, where I think AI can just make a quick turn and, kind of get right back into the mix of things. So do I want to buy more NVIDIA? Well, I just bought NVIDIA this past week. Do I want to buy more AMD? I do. Yeah, I mean, I definitely do. I like both of these stocks a whole lot. I haven't really been paying attention to what Netflix is doing right now. 93, that's where it was at the beginning of the year, actually. It's we had a little bit of a trough down here, down to 76, and I said that's where I wanted to buy more. So no, I don't want to buy any more at 92. They are raising their monthly subscription price again on Netflix. So that's probably going to have a little bit more upside. The market probably already priced that in. We got 22% of upside, but what I want to buy that compared to an NVIDIA with 60%? No. And it's already sitting, fairly comfortably where it was. So I'm not really getting the value here. Yes, it hit 134, but I'm also seeing it right in line with where it was at the beginning of the year when other stocks have traded lower, right? So for me, I would be willing to bet on any of the big AI players. Software is still tricky, right? I'm looking at Adobe and the Salesforce, CrowdStrike. I'm looking at those still being a little bit more of a laggard, right? We're looking at Adobe here at 233. And if I look at it year to date, yeah, we're at that low, right? We were at 339 in January at some point, January 8th. So yeah, I mean, this is getting to be something that's almost too cheap to ignore, but I just don't know when we get out of our own way with software. So for me, I would rather buy some of the hardware components, the ones that are building out the AI platforms, rather than the ones that might be disrupted by AI. And I think that's why Adobe and a lot of the other software stocks are still in the doghouse, is because of the fact that AI could disrupt all of them. So we've talked about oil last time. They're still doing well. Chevron at 211. I mean, that is going really well if you're a long-term investor in Chevron. Exxon, Valero, any of those have been doing really, really well. And I think they're going to continue to do that as long as oil remains high. But I wouldn't chase this. I wouldn't be buying oil stocks right now because of the run that they're on. And we know that it is a temporary run. I don't think that oil is going to stay elevated for years to come. I think we've got to come back down because this is going to be putting too much pressure on consumers in order for them to make enough money to actually do anything with this, right? Chevron's got a short window where they're doing well before the oil prices just really start to crumble the economy and who can pay for these higher rates for longer. So yeah, we've got 211 on Chevron right now. We were looking at Chevron being in the 160 range back in January, and now we're up 30% roughly. So it's not something I would chase at this point, but a lot of the other names really do make sense to me, right? So SoFi, I want to see this one work. I really do. I've got a whole bunch of shares in this thing, and I'm not just endorsing it blindly. I'm not doing that. I do think that is a quality company. I think that the build out has been really, really strong. The fact that we've got 60% of upside is nice to see. It is going to be more rate sensitive. And as rates could potentially go up by the end of the year, are people going to refi? No, they're not. So we've got that problem. We thought that rates were going to be coming down. That is why I was betting on SoFi and Bitcoin to go higher. But now that they haven't done that, could it be the time to buy them? I think that it could be, right? So is that where I want to put my money? I would say I like it. And I don't want to necessarily dump more money into Salesforce right now because of previously stated software problems. Same with Adobe, AMD, and NVIDIA. I would buy right now. Microsoft, I would buy right now. Amazon, yes. Celsius doesn't look like it should be caught up in as much with rates, but a weakening consumer, slowing jobs, higher unemployment doesn't look as great for it, but we've got the most amount of upside when it comes to Celsius. ELH has 106% of upside, sitting at a 33. So that one could rebound pretty quick too. If these rates, actually not even rates, if oil comes down, I think Celsius is going to rebound quick because that $20, $30 at the gas pump, versus 40 or 50. Now you can run inside and grab a drink, and that could be a Celsius beverage right now. So I think that could be a big driver for growth too. If you're looking at a fuel bill that's $50 and you're used to 30, well, maybe I'm not going inside. I'll bring a water from home. So that's kind of my thought there. GEV probably already ran enough. I will double check that. Only 3% of upside there. I wouldn't have thought that we would have had much. So that limits me down to Nike, which I kind of already said, that's a longer term time horizon. I think we have a little bit more time to buy that at a discount. Similar with SoFi from the standpoint that rates could be going back up by the end of the year. So that leaves me with AMD, NVIDIA, Microsoft, Amazon, Celsius. And of those, Microsoft is the one that's going to be the biggest laggard thus far this year in the Mag 7. And then Celsius gives us the most amount of upside. So that is a tricky one. Maybe we just say, hey, we're going to buy both of them. We're going to buy Microsoft and Celsius because I just said that we want to be buying more on this dip. And hey, put your money where your mouth is, right? So I want to buy $200 of each. And that's not a normal thing around here. I'm normally pretty strict with my rules, but that's what I'm going to do. I'm going to buy 200 of Microsoft and 200 of Celsius. We're going to try to buy this dip, guys. That's where my head's at. I don't want to see everyone run for the hills and sell it at a loss when you might only have 3 months of pain. And I think at this point, yeah, we could continue to go down. But if we do, I'm going to continue buying, and I'm going to do so at an accelerated clip, like I was saying. If your stock is below 10 to 20% of that peak number, I would be buying more, right? As long as nothing fundamentally has really changed with the business. If it is short-term pain, I would be looking to add more to my position than especially running for the hills. I don't want to do that. And maybe you could just continue to dollar cost average depending on what your income or cash on the sidelines looks like. But I wouldn't run away from it. I really wouldn't. So hopefully that brings a little bit of clarity to what I'm doing in the market. Where my head's at on maybe some consumer discretionary, some software companies, some other tech companies we talked about. Energy, Vernova, Chevron, I'm not buying at the moment because of the fact that they've already run so high. Bitcoin, I do want to buy more. That wasn't necessarily the talk of this week's podcast, right? So being the fact that we were at 93.7 to begin the year, and I said, hey, I think we could probably get to 120 or 130 in Q1, and that's not happening for all the said reasons that we just laid out: higher rates, Iran problems, geopolitical tensions, unemployment rising. I do believe that we get out of this and we start to see Bitcoin being one of the next ones to really run. So I do want to add some money there. I've needed to add some money there for a while since the whole Bitcoin scam. We covered that back in December. That was painful. So now we're in a rebuilding phase there. So that's what I got, guys. I'm going to be buying Microsoft and Celsius, $200 of each. And I'm going to be adding some Bitcoin to my own personal accounts. So that's what I've got. I've got links in the description for E-Trade, for Webull, for Crypto.com. You get a little bit of a credit for using my links, so I definitely appreciate that. And there's all the links in the description for other episodes. If you want to go back and listen to what happened to the Bitcoin scam, to not have that happen to you, that's great. Protect yourself, change those passwords, make sure you're using two-factor authentication, and make sure that you're clicking on a website that is legit. I'm not going to beat myself up again on that one. That's already painful enough. But yeah, so we've got all that. Hopefully that gives you guys a little bit of clarity. Please make sure you like, subscribe, and share. It definitely does help grow the podcast. And thank you guys for stopping by. I will catch you in the next one. Take care.